Welcome to The Glass Ceiling, the podcast where business leaders share their stories, struggles and triumphs.
There is a lot in that. There's a lot of learning.
We sort of had different views on how the business should be ran.
The next 10 years looks like for South Australia.
Startup's the easiest.
I'm your host, Marissa Hankinson from Wavebreaker, and I'm passionate about amplifying their voices. Join me as we explore the highs and lows of innovation, entrepreneurship and leadership. From founders to CEOs, our guests will share their insights, experiences and advice on how to succeed and make a lasting impact. Get ready for inspiring conversations and valuable lessons. Let's shatter the glass ceiling, one story at a time. This is episode 1, Glass Ceiling, season 3 with Oliver Ciancio. Does that work? Okay, fantastic. I'm delighted to introduce Oliver Ciancio into the podcast and into our studio for the Glass Ceiling. Just telling you a little bit about Oliver Ciancio is a seasoned corporate strategist and deal maker. He's currently serving as the head of mergers and acquisitions at HU Group. With a strong background in finance, law and business, Oliver brings a unique blend of expertise to his work, driving growth and value creation through strategic acquisitions and partnerships. As a trusted advisor to business leaders and investors, Oliver has a proven track record of navigating complex transactions. I've just heard from as little as 100,000 all the way up to 20 million. His insights on intersection of business, finance and strategy have earned him recognition as a voice in the industry. So we're going to join Oliver today, or Ollie, as your friends call you, and hopefully I am a friend. I am a friend.
We will be, Bobby, today.
And we're going to talk about all things deal. So welcome to the Glass Ceiling, Ollie.
Look, thank you for having me. I think one of the things that I've noticed is a lot of business owners just do not understand the business brokering, M&A space, how they're different, and how the whole real spectrum of business brokering all the way through to M&A works.
Correct.
So
yeah, and I think I said off camera that, in season 1 and season 2, we've had some great guests on who have built their businesses and then subsequently sold them on. And it's a great inspirational story to hear about the journey of them growing their businesses, but really what happens at that pinnacle moment of how does that come about. So do you want to talk a little bit first, because this isn't your first career. You look very young, by the way.
thank you.
So how did you start out? What was your early career like?
Look, it's probably a pretty common one where, you come out of school and you don't really know what you want to do, and you get a careers counsellor at school who says, hey, I think you're good at mathematics, I think you're good at problem solving, why don't you become an engineer? And really that was the whole nexus of kind of the next 7 years of my life, driven by that one conversation with a careers counsellor. And I ended up going into engineering, did a science degree as well, spent 5 years at uni doing that, and then came out as an engineer and worked for quite a large multinational mining company and did everything from exploration, where I'd get dropped in the middle of nowhere with an exploration crew and have to lead the drill crew, all the way through to designing mines, to working on operational mines. And I worked at this multinational for a number of years and got to a point where I realised that working in a business wasn't as fun as working on a business. So I kind of set up a little business on the side that was selling mining surveying equipment. And it kind of got a bit of a life of its own.
So you had a startup yourself?
I did. And look, I was at that period where there was not much support. So I lived in WA at the time, and there was, at the time, very few incubators or accelerators or any other formal education on how to do a startup. So I kind of bumbled my way through it. And it kind of got a life of its own. And I think I was, right time, right place where the mining boom was happening. I had industry contacts because I was a mining engineer, but I knew nothing about running the business.
Okay.
So it kind of bumbled along, and it was a great little earner on the side. And I got to a point where I was like, I don't really want to be an engineer anymore. I don't see myself doing this for the next 40 years. The passion of actually building that business
Was what fired you up?
It did. It far exceeded what I could have ever have got from being an engineer. So to the surprise of everyone, one day I just decided I don't want to be an engineer anymore and just quit my job like that.
Okay.
And everyone was like, oh, what are you doing?
Especially if this was at the height of the mining boom, they must have been going, what are you doing, Ollie?
They did. And as I'm sure you know, in the mining boom, there weren't enough people. Were getting paid very well. I was very young at the time. I think I was 23 or 24 and getting quite a ridiculous salary, which, in hindsight, you look back and say, oh, was it a good move quitting because it was such a stable job? but I think like the learning for me was that you got to follow your passion. Like I wanted to be really good at what I did, and it's very hard if you don't really love what you do to get up at, early hours and work until 10 at night sometimes when you have to.
Yeah.
And that's kind of driven my career. I think since I've left engineering, I've been very passionate. So, working a long day doesn't really feel like a long day because
if you're enjoying it, it doesn't. It's like the clock doesn't happen when you're actually enjoying.
It's
something.
very cliche, isn't it? But it's true. Like, and to me, I actually found that. It took a while to actually kind of navigate through that though. Like I knew I liked working with businesses. I knew I liked the fun of startups and scale-ups and small businesses. But from the point of leaving engineering to the point of kind of today, it's taken a bit of a journey to find out exactly where I fit in that space and what I like. Yeah. And I've done everything from, as you know, from investing in startups to being a co-founder in a startup to working in investment firms and private equity, and really to where I am today as, a business broker and an M&A advisor. And all of them have kind of led and built on each other to get to this point today. But yeah, it did take a number of years to get to that point, probably about a decade.
Yeah, and that's okay, because that's a decade of learning. It's a decade of building your knowledge. I never think, the way I sometimes look at it is, on the job is literally your life apprenticeship in getting where you need to go to. You did the uni thing, but did you go back and study at all?
I did. I went and did a Master's of Finance, and I was kind of running a startup at the time, and went over to London and spent a bit of time studying over there. And really, my two uni journeys were so different. So the first uni journey of doing engineering and science, I kind of just carried myself through, and it wasn't that hard, and I didn't really push myself. Whilst the second time, I dedicated pretty much every waking hour to it. And I think I ended up doing the Masters in a year instead of 2 years because I just loved it so much. And I was just kind of overloading with subjects and just going crazy with it.
Yeah.
And it was such a different experience. Like I look back now and it doesn't even feel like the same thing, even though they were both uni degrees. They were both at Adelaide Uni. One was this, I have to be here. I'm kind of fulfilling a need. It's hard to wake up in the morning.
I sometimes think a Master's, I think you're usually a little bit more mature. You're a little bit more of a self-starter kind of reason why you're doing it rather than the traditional career advisor. So what happened to your startups? I'm curious. I've got to ask.
Look, it's funny. As I've got older, my risk appetite has changed. So when I was young, I had a very high risk tolerance, as most young men do. Like they
especially if you've been in the mining boom and earning some big money at a young age.
Yes, and so I did everything from investing in speculative exploration companies all the way through to investing in startups that were, very, very high risk and like potential high return. Look, as I've got older, I've kind of progressed on how I invest. So I've gone from investing in very risky startups to now kind of more, I guess, SMEs is kind of, so small to medium enterprises.
I'm going to be really awkward now because I think this is a really funny thing that happens, right? Everyone says SMEs, right? But my perception of an SME is very, very different to what your perception of an SME is. So I'm going to say to you, can you just clarify in your head what you think an SME is?
Yeah, so look, a small to medium enterprise or SME, look, it's a range of companies. So it's anywhere from like on the smallest end of the spectrum, a sole trader, all the way up to probably about 50 to 100 employees. And then everyone kind of defines it differently. But really, that's kind of the space that I kind of play in up to.
And what kind of turnovers would you fit in that space?
Oh, look, once you're probably doing more than 15 mil revenue, you're kind of starting to push on that real topper end of medium enterprise. Yeah, so probably sub 15 is kind of my ceiling for it. But you hear 100 different definitions of where that is. Yeah, as you've talked about. So yeah, that's my definition of it, and that's kind of where I play. Like now with business brokering, and then also with investing. Yeah, and I think back to your point around investing, like I've had a few startups that have gone okay and are still surviving and, on the journey. But look, as you know, the riskier they are, the longer that journey takes.
Yes.
Like you hear these rock star stories online where they're overnight successes, but as I've learned the hard way, every overnight success, well, not everyone, but most like overnight success is a 10-year journey to get there from the startup founder. So things that I've invested in 10 years ago are actually now starting to get traction. Yep. There are others that have failed. And look, I think if you're going to invest in the startup landscape, you've got to expect that. And as a mid-20-year-old investing, I didn't expect that at all. I was like, I'm going to be...
You're going to be the next Elon Musk or something like that. You're just going to be like...
Everything will turn to gold. Like, just touch that one, gold.
You're a mining engineer, but not everything turns to gold. Everything's a gem.
Very true. And like, yeah, you have to learn that the hard way. Like I think it is very, I don't know any investors who haven't had a few kind of war stories of things that haven't worked.
Yeah.
I think it's having the courage to go again and again and have conviction that you can actually get one right or get multiple ones right. And I think I do see this far too often where you get people who have made money in other industries that want to do startup investing, and then they go all in on one, or they invest in one that doesn't go well, and it ruins it for them and they never go again. And it's a real shame because you get these incredibly high net worth people, and there's many examples here in Adelaide that I can think of where these guys have gone in and they've put all their eggs in one basket with a startup.
Yeah.
And then it fails, and then they never invest again. Instead of being like, okay, for the first one, maybe we'll go a bit smaller or we'll spread our risk a bit.
Yeah.
And I think I was lucky enough to do that, where I didn't put all my eggs in one basket for one.
Well, that would take up, or like, that could be all your investment, your portfolio, or, and that's what they say, you should have a portfolio, not just, as you say, all eggs in one basket. So what would you say now? Are you sort of like medium to low risks, more strategic in your decision making?
Yeah. I have very strong conviction that there are amazing small businesses out there and medium enterprises that have been owned by people for 20, 30 years, and they've done all the hard yards to build the business, and they've grown it, and they've got to a point where, it might not be a tech startup that can become $1 billion, but it's a very good business making a few $100,000 in profit a year, and it's done that for 20 years.
Yeah.
That is the type of business that I like because the risk is relatively low.
Yeah.
And strangely, the price is very, very cheap as well. Relative to what you'd see on the ASX or high growth startups. And that is something that I think is due to the fact that there's an Australian kind of mentality that you either invest in rockstar startups or you invest in property and then maybe ASX listed things.
Yeah.
And there's very few people that are actually kind of taking the baton on from like small businesses and bring it to the next generation.
Okay.
And that drives the price.
Yeah.
And that's kind of what originally got me interested in being a business broker, because for me and an M&A advisor, because essentially it is a paid way that I can go and help others, but at the same time I can see opportunities for myself and I can see where the market's going and what's happening.
Yeah.
And use that as kind of my inside knowledge.
Yeah, well, it's educating you along the way, isn't it?
It is. And like if you can get paid to be educated, it's...
Oh, that's a pretty good deal. It's a pretty good deal. But you mentioned Adelaide. So what got you from WA to South Australia?
Look, I grew up in Adelaide.
Okay.
I moved to WA for mining.
Yeah.
I did a bit of mining prior to that over actually in New South Wales as well. I've lived in Sydney a bit. I've lived in Darwin a bit and lived in London. I got to a point a few years ago where I just wanted to come back to Adelaide. And it was because I'd been gone from Adelaide for quite a few years, and it was a very different experience coming back. When I'd left, there was no startup scene. There was very little M&A activity and very little kind of in the way of kind of investment funds. And I came back kind of 2022 and, 14 had started up in the startup scene. There was a lot happening and a lot going on. And I just wanted to be back. I think being close to family kind of drove that decision, and then all that was happening in kind of that space as well. Yeah. And they just convened perfectly, and I just jumped on board with that.
So even though you're based in Adelaide, do you work nationally?
I do. So I help businesses around the country. Typically, though, at the moment, I've got a lot in Darwin.
Okay.
So I'm up in Darwin every few weeks at the moment. I'm helping 4 businesses at the moment sell up in Darwin.
Okay. Is that a sign of Darwin as a state? Is that declining? Is the population? Is it a sign of the state?
I think so. Like Darwin's got relatively small population. Darwin and Palmerston, I think, have 200,000 people between them. And there's really good business brokers that do a lot of the smaller end deals.
Yeah.
There aren't that many people that play in that $1 to $20 million sale range. Okay. And the reason is that on the bottom end of like sub $1 million deals, like it's all about sales and being able to get it in front of as many people as you can. When
so
you
it's
sell.
A volume game.
It is a volume game, but as you kind of get higher and higher up that kind of value spectrum, it becomes far more technical.
Right.
And like the reality is in Darwin, like you just never get exposure, or you get very limited exposure to that. So there isn't a real good pipeline of young people coming through who have learned how to work in those complex deals.
Yeah.
And I think that's where the niche has been for me, where I've spent a bit of time up there and I'm realizing there's a bit of a gap in the market, and people are responding to that and really coming to me and saying, hey, can you help with these larger, more complex deals? Because we just don't have the expertise available.
And is that more merging it with maybe other businesses that are already operating interstate, and it's more they're making Northern Territory like another arm of their business? Is that sort of, rather than a direct sale?
Yeah, look, we can go very deep here. I think if you look at who buys businesses, you can really break it down into like sub $1 million, maybe 1 million to 5 million, and then 5 to 20 mil. And normally sub $1 million businesses, it can be anyone. So it can be anyone from mum and dad investors to people who are looking to move from overseas and looking to create a business, to employees of the company that want to buy the business.
So succession planning.
So there's a whole range of different types of buyers. As you kind of go up from $1 million to 5 million, you start to see a few more competitors come into the space and be like, look, they're larger competitors. They just want to buy out this business instead of having to win the work organically. It makes a lot of sense to just come in and say, hey, I'd rather just buy $5 million worth of revenue.
Yeah.
And it's kind of taken off in the last few years, where previously it wasn't such a thing for some like smaller businesses that were sitting around that, $1 to $10 million revenue to buy or merge with other companies. Mm-hmm. And it's become more and more popular when you look at organic growth can be very hard to get in some industries.
And it's costly.
It is very costly, isn't it? And takes time. And
as you said, it's that, if you can jump from that 5 years of hard work to doing that through a deal, and if you're serviceable and, you've got that behind you. So I'm going to jump in a little bit here and say, what criteria as a business owner makes you eligible to buy another business? What is that due diligence? Is it the bottom line? Is it the serviceability? Is it the length of experience? What sort of criteria or tick box thing sort of makes that?
Look, it's a very multi-layered question. I think at the starting point, the first thing to look at is what we call future maintainable earnings. So we want to know that if we buy the business tomorrow, next year's profit is going to be at least the same or better.
Yeah. So you don't want to be going backwards.
You don't want to go backwards. So an example of that is, say you went and bought a business and the business owner left tomorrow and he was a key person in the business, or she was a key person in the business, and they had all the contracts were attached to them as individuals.
Yeah.
When they leave, there's a good chance all those contracts will go and revenue will drop off by a large percentage.
And that's high risk.
It's very high risk. So the learning here for both sellers and buyers is that when you're buying a company, you just got to make sure that earnings that happened last year, there's a good chance it will happen next year and the year after and the year after, or there's a growth potential that actually layers on top and becomes even better. And that's kind of the ideal company, where it's not only getting last year's earnings, but you're getting a bit more on top every year.
So that's, you're looking at their pipeline, you're looking at their secured work. So, it's that, they've got 3-year contracts, they're only in year one, and, is there a percentage of renewal, or is there extensions? It's those kind of things that you're really, really looking at, that work in progress and that pipeline. And
this has become a bit of a service that I've offered just through the need of business owners. Like, there are business owners that can see the opportunity, but they don't know where to start. Because you're right, like, even though it's just one number, being like, what's the future maintainable earnings? The things that flow off that to kind of deliver that number are very, very complex. So like you said, it's like, what is the customer concentration risk? Is there, for example, like 2 big customers that one might leave next year, and then that reduces your revenue by 50%? Is there key person risk around the owner leaving? And like we said before, the contracts that attach to them as individuals. Is there regulatory risk where they've done something wrong in the past that's been hidden that might come out next year?
And you probably have to future-proof that a little bit with compliance, law changes, things that are happening or even talked about on the political landscape that could actually have an impact on that business too.
Yeah, and when we kind of do what we call buyer-side advisory, so we help people buy businesses, we kind of break it down into like a first initial screening. So we sit down with people and say, if you want to buy a business, what are the 10 criteria that you're looking for? And they can be very high-level things. So, for example, they're based in Adelaide, they've got between $1 million and $3 million in profit, things like that are very easy to assess. And that's the first screening point. So you go through and you get that information from the seller, you tick the box, and if they get through, then we move into a period called due diligence. And due diligence is really getting under the hood, verifying some more complex things, and all these things that we've talked about previously around understanding fundamentally about those maintainable future earnings. So it can be broken down into legal, technical, compliance, competitor risk, market size, industry. And there's a whole range of factors that we put together, and we have a checklist off the back of that. And that can range anywhere from 30 questions all the way through to 200 questions, depending on the size of the business.
And I suppose the time frames for this can be as little as like 6 weeks all the way up to like two years sometimes. It's depending on the value, the size of the business, etc.
Yeah, look, a great question and a great observation. I think the hardest part normally is actually finding the right business. So the way we look at it is, when I used to work in private equity and used to work in the investment landscape, we had a rule of 1 in 100. So if you looked at 100 businesses, typically you'd invest in one.
Wow.
And
I didn't think it'd be that low.
yeah,
Just saying.
yeah, I know, and that requires a lot of work to find that one. And sometimes you get lucky and you find one earlier. And sometimes if you know exactly what you're looking for and you're very targeted, you don't need to do that. But typically if you're working for like a larger firm or you don't know what you're looking for, you need to really sift through a lot of companies to find the one that matches with you, that solves your problems, that really feels like you can integrate well together. And that really drives, once you've found the right business, it's quite straightforward from there around, okay, doing the initial screening checklist, doing the due diligence, getting the legals in place and kind of transferring ownership and then integration. But that hard part for most people is actually finding the right business. And that can take anywhere from, like you said, a few months all the way up to 2 or 3 years.
I'm going to add here, because what we're talking about is, I would say, is factual, black and white. But what about the soft stuff of culture? And, how kind of is that measured when you talked about integration and transition and, even that in itself is a risk, but how do you even begin to measure or assess that?
Yeah. As an engineer, it causes me a lot of grief. As you can imagine, I like to quantify things. Look, I think this is where individual leaders are very, very good at it, because, and you'll see some people are very good, some people are very bad, and it's very subjective. So, for example, like you bring, as you said, you bring 2 different cultures together when you merge and integrate 2 businesses, and being able to align those cultures and get them to come together is not a simple checklist.
No.
Unfortunately, I wish it was. And you see that in the results. A lot of mergers and acquisitions fail at the integration phase. I don't know the exact percentage off the top of my head, but I'd say 40 or 50% of failed mergers and acquisitions happen at the actual integration phase, in my experience. And a lot of it comes down to culture. There's a company that I've just been helping over in Sydney with this, where they've sold to a bigger company and they're just completely misaligned. And I think it's a bit of both parties, where before they'd kind of gone through, from the seller perspective and the buyer perspective, they should have really understood, okay, how they work together, what culture means for both parties, and then seeing if there was a way that they could actually kind of bring them together. And at the moment, there's a lot of headbutting, and they've brought me in kind of post-acquisition, and we're about 4 months down the track at the moment, and there's some serious friction. And it's very, very difficult for the seller in this case, because part of the seller's sale price is tied to earn out over a period of time where they're not getting all the money up front.
Yeah.
So what happens is, over 3 months, 6 months, 9 months, and 12 months, they're getting tranches of payment. And
if that's starting not to work, or there's some...
Exactly, yeah. So there's a lot of issues around getting the 3rd and 4th payment and the tranches that go with that.
So you've just said there that it's not just about brokering a deal and walking away. You can actually be there for an element post-sale as well.
Yeah, and once again, this comes down to business size. I think the larger the business is, the more that post element matters. You'll see on the sub $1 million space in terms of business sales, this is where they're called primarily business brokers. And as you can imagine, brokers infers that you're just brokering the deal.
Yeah, and then you walk away.
And that's what you walk away. And that's what you see most of. Like, if you're going to broker a smaller gym or a cafe, it doesn't need a year of integration. If you're going to broker a deal that is, a $5 or $10 or $20 million company, the chances are there's a lot more technicalities, it's a lot more complex, and there's a lot of work to be done post-sale. So you might sign all the deal and get it done, and then it's like, we actually need help with
This is when the work starts.
The work starts, yeah.
Work starts with other people now, not just these at the top.
Yeah, and very, very, as you know, culture is the most important thing ever. And I think there's a lack of, in my experience in the space in Adelaide, of people that really specialise in helping with integration. there are people that do parts of it. So some people do, the IT integration. Some people do the accounting integration and finance integration. Some people do the HR.
Or it's more operational kind of integration rather than more at the strategic level.
Yeah, I think that operational with HR, just getting people to work together, bringing operational processes across, there's a bit of a lack of expertise and support in Adelaide. And I think there's a real opportunity for people to kind of step into that space. I think, like I said, the accounting and IT parts are very straightforward and checklist driven. The other more subjective part of it isn't done that well in terms of advisory space, or there's more opportunity for it in terms of where someone could move into and really take that space.
Okay, that's it. That's really. We've talked about Darwin. Obviously you work interstate. And when you came back to Adelaide, we've got Lot 14. It's very much incubator. It's an exciting time here in South Australia. What is the perception of South Australia outside of South Australia in our space? And I mean, our audiences for the glass ceiling are national, but I just, I'm South Australian, not by birth, because you can tell by my accent, but I'm very proud of being in South Australia and operating a South Australian business. But what is that perception?
Look, it depends where you go. Like Darwin, they kind of see Adelaide as a big brother. Like a lot of people come down to Darwin. There's a lot of advisors and service providers that go up to Darwin to help out with things. Yeah, it seems
to be that like trunk, doesn't it, in the middle?
Yeah. Look, when you go over east, Melbourne and Sydney, always have that kind of big brother mentality, looking to Adelaide as being the smaller kind of city of churches. But I think that's slowly changing. You're seeing a lot of, I almost call them expats, moving back to Adelaide, who've worked for very, very high profile companies overseas and interstate, and you're starting to see that buzz around it. I think it's something that's a work in progress. The mentality that I'm seeing in kind of the business brokering M&A space is that Adelaide is rich with a lot of very small to medium enterprises that are great companies. So you're seeing a lot of acquisitions happening cross borders where, like you mentioned before, there is the opportunity for people who are based in Sydney or Melbourne or Brisbane or WA to get a presence in Adelaide. And instead of going and setting up a new base there, you just go buy a company that's based here. And I think over the last probably 3 years, there's been a real uptick in that.
Okay. Yeah.
Yeah.
Good to hear. So one of the things you also mentioned a little bit off camera, we've talked about you've got to a business, you talk about business brokering, but what happens if you were in a business and you wanted to keep that business? And we talked about equity and growth. What's your experience in that space?
Look, it depends, because you can do it in the business brokering space as well. So for example, last year, this guy came to me and he was mid-40s and had an incredible business in the digital signage space. And I worked with a group of guys to structure a deal. And really the deal was unlocking some capital out of the business. Because if you think about it, if you're a business owner, you can have millions of dollars tied up in your business.
Oh, 100%.
And it's not like on the ASX where you can suddenly be like, I'm just going to trade a few of my shares away, get some liquidity for those shares. Those shares are stuck. So if you think about it from a personal perspective, a lot of people have home loans. They're putting their kids through school. There's a lot of drain on finances there, but then they're sitting on an asset that could be worth 2, 3, 4, 5 million. So we worked to kind of develop a deal where he would sell some of his shares to a buyer.
Yeah.
But he would retain control.
Okay, so it's that in excess of like always make sure you got the 51%, but yeah.
And that isn't really done that much here. You're seeing it a lot in America and a lot in Europe where business owners are realizing, hey, I've got this great business. I don't want to have to wait 20 years until I sell to release some of that capital.
Yeah.
Why don't I try to sell some down? And in this case, we found this fantastic guy up in Brisbane who had run a company that had 300 staff.
Yeah.
Who didn't want to work full time, but wanted to come in as a passive investor, but sit on the board, offer 1 day a week strategic advisory work. He was semi-retired. He was a perfect investor for that business because not only did he release the capital for the guy selling, but he also could actually come in and contribute with things because he had grown a business from a few staff up to a few hundred staff. So he had a lot of learnings that he brought across and actually could help the owner with. And I think that's probably another really important point. A lot of these owners are on islands. Like they don't have people they can turn to. They don't have support.
And that really is that peer-to-peer then, isn't it, really? And is it, majority of the time, is it just releasing the equity out of that asset to, enjoy life and get a bit more of a work-life balance? Or is the majority of the cases it's to take the business to the next level?
Yeah, look, it's a great distinction. There are two key things you can do. One, you can sell your shares. Where you sell your shares, you get the money. The company doesn't get the money. You get it as an individual who owns the shares in the company.
Yeah.
Or two, you can raise capital. And raising capital is you're putting money into the business to grow it.
Yeah.
And there's two completely different investor sets that kind of go after different things and knowing where you want to go. So, for example, if you were in your 40s or 50s and you felt like you had another 20 years, you don't have to get money off the table. You don't have to sell your shares. You can keep all your shares and say, hey, I'm going to issue some new shares, get more capital into the business to grow the business.
Okay, so it's not about necessarily leasing. Okay,
No. So there's ways where you can say, okay, hey, I want to give up 10% of my company to a new investor who's going to put the money into the company. He's not going to give the money to me as an individual. He's going to put it into the company to help that company grow.
Yeah.
And that is an important distinction. And I think a lot of business owners miss that when they go and they either try to sell their company or they try to raise capital and they talk to the wrong investor base because they're very different investor types who go from...
They all have their own makeup, really, don't they? And it's interesting because even in this conversation, there's probably been 5 to 6 different types of investors, buyers, brokers that you've mentioned. And if you're a business owner, and I will bring this back to, you know, our listeners, if they're a business owner, they may be seeking just one bit of advice, which actually not necessarily being aware that there are other options on the table. So this actually brings me to, how would people get in touch with you?
Look, you can get in touch through the website hugroup.com.au, so hugroup.com.au, Oliver at hugroup.com.au. You can go to my LinkedIn. It's just my name.
You might need to spell that actually, because so I had to struggle with the pronunciation.
Yeah, so it's Oliver, Oliver, and then Ciancio, Ciancio.
Perfect.
There aren't many people with my last name, so I should be easy to find online.
You'll be there on number 1. Well, thank you so much, Oliver. I actually got a lot out of this conversation, and thank you so much for being on The Glass Ceiling.
Thank you for having me. I really enjoyed it.
Thanks for tuning in to this episode of The Glass Ceiling. If you've liked what you heard, please subscribe, as we'd love to have you as part of our community. We're grateful to our guests for sharing their inspiring stories and insights with us. This podcast was brought to you by Wavebreaker. Join us next time as we shatter the glass ceiling, one story at a time.